Hey, what's up, everybody? I'm Doug Shoemaker with the Shoemaker Loan Team at Homestead Financial Mortgage, and welcome back to 1 Minute Monday. I've been in the industry for over 20 years, and each week I break down the complexities of what's happening in real estate, mortgage rates, and the economy, just how you consume it best. So, if you couldn't care less what a Japanese candlestick is and you just want to know what time it is, the next minute or so, it's just for you. Now, if you like to know just a little bit more about how the clock works, stick around a little longer for some additional information to make the data make just a little bit more sense. And then for my friends who really like to know how the clock's built, I've got a deep dive towards the end just for you. All right, let's go ahead and get started. So, the national average mortgage rates per Mortgage News Daily, and I'll put the link down below. For a 30-year fixed rate, we're at 6.04. The conventional 15-year is about 5.6. The FHA 30-year is 5.63, and the VA 30-year is at about 5.65. Now, remember, everybody, this might not be my company's rate or your rate. These are national averages. Different risk levels get different rates based on that specific risk. Your personal rate depends on a lot of things like your credit score, your down payment, the loan size, the property type, whether or not you're paying discount points, and of course your lender's pricing model. Now, let's go ahead and get on to the news. Inflation came in just a little bit hotter than expected. Housing construction has improved. Pending home sales dipped just slightly. GDP slowed. And mortgage bonds are actually pressing against a ceiling that they tested multiple times last in this year and are just struggling to break through. Now, will this week be any different? I guess we're just going to have to wait and see. Now, for this week's Refinance Indicator, we generally look for about a 0.5% to a full percent, depending on your loan size. So if you've got a loan around $100,000, you might need a full percentage point or more for it to make sense, where loans over $300,000 may only need a 0.5% to maybe 0.75% improvement to make a refinance worthwhile. It's definitely not a one-size-fits-all, so make sure you reach out today to see what makes most sense for your personal situation. Now, with the national average around 6.04 on conventional loans, that means that if your current rate's about 6.79 or higher, we should definitely be having a conversation. If you're at 6.25, it's probably not so urgent right now, but if you're over 7%, we should definitely be talking. And the right strategy for most people right now, yep, it's still patience. So if you just wanted to know what time it is, your work here is done. Now, let's go ahead and talk about how the clock works. We've got the Fed's preferred inflation gauge, which is personal consumption expenditures, or PCE. And headline inflation rose 0.4% for the month, and the annual rate is now at about 2.9%. Core inflation also saw 0.4%, and it's sitting at 3% year over year. And that's still above the Fed's 2% target. So when inflation runs hot, the Fed stays cautious and rate cuts get delayed. However, if upcoming monthly readings are moderate, some of the higher numbers from early last year are about to fall off the annual calculation, and that could make inflation look much better pretty darn quickly. Now, progress here isn't gone, it's just a little bit uneven. Now, housing starts rose 6.2% month over month to 1.4 million annualized. Permits rose 4.3% month over month to 1.45 million. And completions came in at 1.53 million. Now, that sounds really strong, but builder confidence is still pretty low. The housing market index is sitting at about 36, and anything below 50 means that more builders think conditions are poor than good. So yeah, construction improved, but supply is still not flooding the market. But inventory is increasing slowly, not necessarily explosively. Now, pending home sales, they actually dipped 0.8 month over month. They're down 0.4% year over year. And current sales pace, it's around 3.9 million annualized. And weather likely impacted the South and the Northeast, while the Midwest and the West actually saw gains. Now, an index level below 100 suggests that we're running below the typical 5 to 5.5 million annualized pace. The translation here is that demand is not dead, it's just sensitive to rates. Now, GDP, it slowed sharply to 1.4% in quarter four, and that was down from 4.4% the previous quarter. So the thing here, though, is everybody, slower growth, it's actually bond or rate friendly. Now, continuing jobless claims, they remained elevated, and Fed Governor Waller, he even questioned the strength of the recent job gains and believes that revisions could come in lower. Now, if labor softness and inflation moderates, the Fed may have room to cut later this year, but it seems like June just feels like the earliest realistic window that might happen. All right, now for my clock builders. Mortgage bonds are compressing against strong resistance. They tested the ceiling multiple times last year and so far this year, and they've been rejected. Now, if bonds break above it, there's roughly 50 basis points of upside room. If they fall below it again, there's about 30 basis points of downside risk before they hit any meaningful level of support. Now, the 10-year Treasury, it's hovering near 4.05. If yields break below that level, rates could improve pretty meaningfully. Now, let's go ahead and connect the dots here. PCE is 2.9 for the headline and 3% for core. GDP, it's slowed to 1.4%. Continuing claims they remain elevated. Builder confidence, it's 36. Supply is improving slowly, and that's a mixed but increasingly bond-friendly environment if inflation continues easing. Now, the market, it's basically waiting for confirmation of this, which brings us to what to look for this week. Case-Shiller is going to be tomorrow, along with FHFA Home Price Index. On Thursday, we've got weekly jobless claims, and on Friday, we've got the Producer Price Index, and PPI, it's going to be especially important. So if wholesale inflation shows cooling, bonds could finally break through that resistance, and when bonds break levels that have been tested multiple times, they generally move pretty darn quickly. For the final takeaway on this fine Monday afternoon, rates are better than they were last year. Inflation's improving, but unevenly. Supply is rising, but not enough to crash prices. And the bond market, it's at a pressure point. So if you're buying, strategy definitely matters. If you're refinancing, timing matters. And if you're waiting, understand what you're waiting for and why. Now, if you want to know your personal refinance trigger, your break-even point, or your buying power, reach out. There's no pressure, no spam, just strategy. And as always, if you or somebody you know is military, law enforcement, or a firefighter, ask how the Shoemaker Loan Team helps our heroes save money through the Home Foundation. Have a great day, everybody, and I'll see you next week.